All right, without further ado, we're going to bring in the tech trader for our lunchtime discussion. Let's see, you're in California, so good morning to you, Sean.
Yeah, I'm in California time zone still, but yeah. So hopefully
It's still morning. It's still morning.
It's 9:05 here, and I've been up, I don't know, four and a half hours, something like that. I will be very happy once we go to Mountain Time Zone.
4.5 hours, man. Sleeping in, I see.
Well, for me it's not, but yeah, for some maybe it is.
Yeah, well, some of us got to open the doors in the building here, Sean. So
yeah, I know
you don't feel my pain.
If I'm up an hour and a half before the market opens, that's plenty good for me. I mean, I'm one of these. The problem with West Coast is that you maybe don't get up 2-3 hours before the market opens, but at the same time, when everybody on the East Coast has been done working for 2 hours or 3 hours or sometimes 4, you're still working. So, from a market perspective, I don't know. Maybe I need to move to Florida or something. I would end up working fewer hours. I can guarantee that.
All right. Well, so let's dive right into the NASDAQ as we're flirting with we're actually now below the 200-day in the NASDAQ, and you've been pretty, I don't want to say bearish, but you've been calling out a potential for a correction for quite some time, and you've noted a lot of your key sentiment signals and some of the technical levels and what have you. Where are we now as we've progressed into the end of October and starting in the earnings season? How do your sentiment indicators look now?
Well, hey, I mean, here's the good news. So, I mean, we have a full-blown correction. I mean, it's weird. It's a lot like the 2016 correction, just not to the same magnitude. But Nasdaq's down. I think at the lows it was down 10.7. So people at least can't say that the Nasdaq hasn't put in a 10% correction. The bigger, again, this is kind of what's mystifying, but it's really not that mystifying, the way algorithmic trading works and flow of funds and market makers and things. But what the bigger numbers, okay, Russell 2000 growth, almost 16% correction. The standard Russell 2000 is down, I think as of yesterday's lows, it was down 13.8%. I mean, those are getting pretty meaty. I mean, it's not uncommon. The nasty correction in 2011, those are down quite a bit more. I mean, both those were down 20. I'm sure at the lows in 2016 from the prior highs, although the cycle highs may have been 2014. That might not be a totally fair comparison because it was a long running correction for small cap and value stocks. But that was probably 25 to 30%. Again, I call that period. That was the near market crash that nobody calls a market crash. And why? Well, because the indices went down, I think 12 to 15%. But I mean, the average biotech stock was down 67%. The average energy stock was down 55 to 60%. The average tech stock with a market cap of less than 5 billion was down 58%. I mean, so there was like massive decimation underneath the surface in early 2016, and we frankly kind of have an echo of that. So here's sort of the short of everything. Yesterday we actually printed some positive divergences between my sentiment scores and the averages, because what did we do? We had a retest undercut low in the S&P. We had a retest undercut low on the NASDAQ. We had a retest undercut low on those small cap indices. And sentiment, the NIMO and the NAMO and various sentiment gauges I use dropped. They went lower yesterday, but they're well above the lows of whatever the lows were a week ago. So the conditions are there. I mean, the conditions are there. Here's the difference, I think. I normally, all things being equal, I probably would be on today saying, I'm buying more stuff. Here's some trades. I think this is the formula that works like 95% of the time. And I think I'm going to increase longs. Here's the difference. Most of the time that I would make that call, we don't have midterm elections 1 to 2 weeks away. And I know everybody wants to say this is rates, and I think this is phase 2 of the FANG cloud bubble unwind. Everybody wants to say this is fear of the Fed. Honestly, I think that we have a lot of tax loss selling. This is a heavy tax loss selling month, by the way. If people don't know that, they should. There's a very high percentage of companies, professional companies, that close their books in October. I think probably a bigger percentage close in September or December, but there's still a pretty big percentage of professional money management shops that close books in October. So there is a fair amount of tax loss selling the last 2 weeks, 3 weeks of this month. And then again, I think the election's a very uncertain thing. I don't think anybody really knows what the results are going to be. There's a lot of speculation. I also don't think, where usually people have a game plan, they say, oh, wait, well, if the House does this and the Senate does this, they have scenarios. Okay, so if X and Y happen, the market is the same or goes up. And if Y and Z happen, maybe the market goes down. I don't think anybody really knows. And so that increases uncertainty. And, I haven't heard much talk about that either. You get a lot of prognostication. Hey, if the Dems take the House, but the GOP keeps the Senate, it's probably a net positive. I don't hear really anybody saying anything because I don't think anybody knows, or I don't think anybody has an idea. So I think that's sort of the incremental thing that is extending the buyer strike. The buyer strike being the fact that just nobody out there with any size really wants to kind of buy stocks right now. They're kind of waiting for somebody else to tell them what to buy or what to lead. So the fact we got this buyer strike, we have low liquidity, it's pretty easy for stocks to get rated lower. It's very hard for stocks to go up on good news right now. But again, these things kind of end, and when they end, they usually end kind of in a flourish. But like I say, I would say that it normally, pretty much all my conditions for kind of quote unquote calling a bottom are there, except we still have this lingering midterm election. And I just don't know. I don't know if we're going to go materially lower, but I also don't know if we're really going to have a big rally before the midterm elections. So until the midterm elections are over, I don't know if you should really sweat the moves, the day-to-day moves in the market.
All right. Well, with that out of the way, let's talk.
How's that for muddy clarity?
Well, yeah, I think it makes total sense. I think it pretty much echoes a lot of the sentiment that we've seen. I almost wish there would be some type of handicapping of what could happen to the market based on the different outcomes for the election, and I guess we'll probably save that. Even though it's what is it, only about 2-3 weeks away.
I think it's 2 weeks or less, but that's the thing. You'll almost always get handicapping. I've literally seen like little to zero handicapping. And again, usually you'll get it because a lot of times people feel like they have a relatively good idea. This is one of those things that I just don't think people have much of an idea. Honestly, hey, you know me, if I think I know something, I'm not afraid to say it. However, if I feel like I don't know something, I'm not one of these people to put an opinion out and just as a guess. Honestly, I have zero idea. I have absolutely zero idea what the election results will mean for the market. The standard response would probably be something like, well, maybe the market would like, what's it called when the government can't get anything done, and there's like an official term for it, where the houses are split and the government has a harder time passing legislation. So basically they have an impasse. Generally that's good. Generally that's good for stocks. But when things are cooking and when you have some stuff getting done, and then when you have things that need to get done like trade deals, you actually don't want a 6 month or a 1 year or 2 year impasse. So I don't know. Like say we'll just have to see. The one thing here's one thing I will say with a fairly high degree of confidence. I do think for many stocks, most of the damage has been done. Let's say most of it being 80-85%. Doesn't mean things can't sell off further. but I think we're in a spot that kind of all things being equal, I think good reports. I mean, we what have we seen trade really well? PayPal. And I even said, I think PayPal report could be good enough to give a short-term market lift. It only lasted for about 4 hours. But you had American Express and PayPal both report. PayPal was good. PayPal's pretty much been up ever since the report. So even on ugly, bloody days, PayPal. Let me just look here. As of the other day, they had not had a down day since they reported. Today would be their first down day since they reported. And there's been plenty of days when the Nasdaq's been down 125 points. So and I think even the day they reported, you had a big nasty reversal where the Nasdaq opened up big and ended up probably putting in a net minus 150 move from top to bottom that day. But again, PayPal's nicely above where they were when they reported. So I think that's kind of where we are. And I also think sometimes you get to a point where I actually see people worry more about further declines after they've already suffered a lot of declines. And the point I've always been pretty good at either riding through or making money on is when you reach the point where what I say this, further declines don't matter. And what I mean by that, even if you get a really nasty kind of flush move, the first good bounce that holds, you basically make the last decline back instantly. You know what that's like. So in other words, you get a big flush. Sometimes intraday stocks are down 5, 7, 10, 15%. Well, guess what? The very first bounce you get, that's a big bounce. Stocks just lift a lot, and so whatever the last bout of damage occurred, you pretty much instantly get that money back on the first good recovery. And I kind of think that's where we are. I think that to the degree if we do have something shockingly bad or something goes down a lot. Again, this isn't an earnings miss. If somebody does an earnings miss, they can go down a lot more, especially if it's an overvalued stock. But I'm talking about the stuff that's already beaten up. Let's say they report fine, but there's some external force that makes stock prices go down. Like I say, I think we're to the point that any further declines for most stocks will get made up on sort of whatever that first durable bounce is. So, and I wouldn't have said that 2 weeks ago. I mean, no way. I would have. In fact, I think I did say, I don't know. I think we're going lower because Nasdaq down 500. I don't think is enough given where we are right now. And now that we've basically doubled those declines, it's easier. I mean, here's the other thing I'll say with pretty firm confidence. FANG rallies basically are toxic. So I think the biggest reason it's easy for stocks to go down today is like early to midday yesterday when, let's say, Amazon was still down 55, 60 points. Most of my stocks were up, or at least a lot of the stuff I'm interested in was flat to green. And guess what? the Nasdaq did rally a ton, but Amazon rallied like 30, 35, 40 points off of lows. And so the Nasdaq lifted a lot, Apple lifted a lot. Well, guess what happened? Pretty much all the stuff that was up, green, flat, whatever it was when the Nasdaq was down and Amazon was down 55 points, didn't really advance very much. So all the market advance yesterday was pretty much just a FANG bounce, and guess what? That's easy to sell. So I think FANG bounces are pretty much toxic. So if we get a bounce and a bounce that sticks, where FANG doesn't rally nearly as much as sort of the average stock, I think that's a bounce that's going to stick and hold. If we keep having these bounces that it's because Amazon bounces 50 points off of lows, I don't know. Those will probably be kind of ephemeral and not last very long.
All right. Well, let's talk about some of the earnings that you've had. You haven't had a ton of them as of yet, but a big one was Trivago, TRVG, and you actually had a question that you addressed from one of our listeners as well. And I think I'll just let you have the floor and let you talk about what your takeaways were from the Trivago call, and then you can talk about how it relates to the question that you had heading into Twitter's.
Yeah. So I mean, first of all, I don't really. I mean, I think I said this a while ago. I mean, Trivago got so beaten up and so cheap that I wasn't really even sure that more bad reports would matter that much. The report they just put wasn't great. I don't even know if it was really less bad because there was still plenty kind of to not. You have declining revenues now. You don't have any revenue growth now. There was some talk about margin improvement, but put it this way, it was not yet a good report, but it was good enough. And that's why I'm hunkered in, and that's why the only thing I've bought or have held or like is stuff that's pretty hated and pretty beaten up in this market, because I think that's the only area. Again, it doesn't mean those names won't go down, but when they have any good news at all, or even just a flat report, I mean, what's Trivago up 16? It was up as much as 20. It's up 16% today. Mm-hmm. Remember too, they got that big investment not too long ago. That I think that's a pretty sticky long-term catalyst. So again, you don't need a good report out of Avago to go up, and that's beauty. And that's basically kind of all the stuff I want right now, because like a ServiceNow, which reports I believe tonight. And this is a name I used to love long time ago. It's just so expensive. No matter how good the company is, just so expensive now. Is there really a report that's going to be good enough to hold these guys, to lift and hold this name for the duration? If it would have dropped 40% from 200, I would say yeah. But this has been a pretty mild correction and again, I don't care how much I like this or used to like it. It just hasn't dropped very much. I mean, this is a very expensive name. Very high quality, and it used to be one of my favorite software stocks. Period. Quality-wise, I still put it in the camp with Workday and Splunk and things, but there's just no way I'd buy it here. And so something like a Now, I think is going to have a much tougher time. As far as the transition, and kind of the question was, hey, Trivago had a good report. So what do you think about Twitter? I would kind of put Twitter in the camp. Again, I'm always focused more long-term than short-term. I don't run my book worrying about what the next quarter is going to be. I think if most people that do that, my general suspicion is that they don't perform that great, because if you sell everything before every earnings report, when do stocks move and go up the most? After good earnings reports. So if you're constantly out of names before positive catalysts, then you have to chase them higher. It's just a tough thing. And the way I do things, I held Google through, there were times I held Google through at least 16 to 20 earnings reports. There have been times I've held Apple through at least 16, 20, maybe even 40 successive earnings reports. I'm probably going to hold Qualcomm through, I don't know, what's 4 years? 16, 12, 16, 20. Successive earnings reports, something like that. So, so the bottom line is I don't overly worry or try to forecast or focus on, is there going to be a beat that's big enough to make the stock go up tomorrow? What I focus on with Twitter is, and what I've said many times, I think it's relatively easy for Twitter to double in size or more. And that's not stock price, that's fundamentally. So, they're doing roughly $3 billion revenues today. I think it's kind of a no-brainer that in a relatively short period of time, put a 15 or 20 or 25% growth rate on it, whatever time frame that turns out to be, but in a relatively short period of time, given, a 15 to a 25% growth rate, Twitter will double in size. And I think if Twitter doubles in size, it will grow earnings and cash flow at a much faster rate than revenues. Therefore, it'll garner a premium valuation. And then there's plenty of things that can make Twitter grow even faster. There's plenty of other levers. There's plenty of other things that they could do. They could monetize they don't monetize their user base at all. They don't monetize their platform hardly at all. I think the data licensing business literally could grow 5, 6, 7, maybe even 10-fold over a 5-year period of time. So my view is, as far as earnings is concerned, because that was the specifically question, I think the bar is much lower. I think the odds are higher that Twitter could have a good earnings report and react positively, but I don't know. There's no way to tell, especially with sort of all the negative aspects influencing stock prices short term right now. Again, how I do feel though is that any further declines, I'm probably a holder or a buyer into. Might even go from buying common to buying options if it's cheap enough. But again, I think in a 3-year period of time, 3-4 years, I think Twitter will basically be double the size of the company it is today, if not even bigger. And I think if that happens, I actually think the stock price will more than double. So because again, you get massive cash flow growth. you get a super profitable business with incredibly high margins once they get above their fixed costs. So it's sort of like what happened. In fact, if you know the history of Google, a very interesting thing happened with Google. When Google's growth rate actually slowed down a lot, and they went through a pretty tough 18-month to 2-year period of time. But what happened, they transitioned from a high revenue growth story to a high cash flow growth story, and that's when the stock took off. I mean, that's when a lot of Google shareholders finally got rewarded for a long-term holding period. And I caught some of that period. But so, their growth, their revenue growth went from like mid to high 30s to high teens, but their cash flow and earnings growth went explosive. And they started spending less money, their margins went up. And again, if Twitter doubled their revenue base, their cash flow and earnings growth would be, I don't even know what the calculation would be. It would probably be twice the rate of growth of revenues, if not more. So yeah, that's kind of where I am with Twitter. I don't overly worry about. In fact, I mean, here's the quarter I was worried about earnings really was last quarter, because the stock was 40 to 46, and there was a lot of enthusiasm. And what was the option trade was that there was tons and tons of call buying on Twitter, and that's your setup for a short-term decline. But I would say the 40% decline in Twitter is probably an overshoot. But we'll see. We won't know until tomorrow. But I would suspect that 40% decline, because they are accelerating their revenue growth, is pretty excessive for a name. But maybe Twitter kind of is a market tell. I mean, maybe the fact that Twitter's gone down 40% is sort of a market tell for that's what more stocks should actually be declining, given the overvaluation that exists out there. So, markets are funny. Lots of things happen. I guess if I were to put odds on it, I'd say, you get 2/3 chance they probably go up post-report, 1/3 chance they go down. Just because of the math. Bad report last quarter. It wasn't a bad report. It was just bad reaction. 40% decline. You went from greed to fear again. That's a recipe. If they report a solid number, I would be surprised if they can't get a lift on it.
Are you at a full size position in Twitter already?
Yeah, I pretty much back am. So I mean, that's the one thing. The one thing I did do is I did trim. I don't know, around 1/3 of my position probably on the name. And pretty much all I've done, pretty much starting from about $33 down to pretty much here. I didn't catch any Twitter really low. I think my best buys on it were like high 27s or low 28s. But basically just call it between 28 and 33. I've pretty much just rebought the shares back that I had sold higher. And that's fine. That's fine with me. I mean, I don't need to be a hero in any one name. I've got what I would call a full position in it, and I don't know if I really, I could overweight it here, but I probably favor. I mean, honestly, right now the sector and the stuff that I probably have a larger overweight collectively is my net 5G/fiber optic bet. Now it's a bunch of names, but. I mean, hey, I just keep seeing good story after good story after good story about 5G, and I know that the 5G catalyst will definitely positively influence fiber optic names, and that there's a whole food chain there, and that stuff's trading just as bad as anything. Not to get too long-winded, but just again, with great examples like Sierra Wireless. I mean, this thing hit 2250. Off a really, really improved quarter. The last quarter was like their first good quarter in a long time, and stock was just stupidly cheap at $16. So frankly, I mean, they could have gone up quite a bit more than they did. But that's a pretty big percentage move. I mean, this thing's done, more than a 50% retracement from 16 to 22. So, and again, there's been no bad news. There's been plenty of good news on sort of 5G deployments, in fact, there was a story today that 5G, some deployments in 5G might be accelerating by a quarter earlier than they were previously thinking. And again, it hasn't mattered. I mean, there's just been so much net selling sort of in tech that there really hasn't been a name that hasn't kind of taken some pain. Even Qualcomm. I mean, has there been any reason for Qualcomm to go down? They've taken a decent. It's not a big percentage move down, but hey, they're down 8 to 10 points from highs, and the highs at 75 were not, that's not like an overvalued high. So you've probably had Qualcomm on a percentage-wise decline a similar amount as like Facebook. And Facebook at highs was, so one of these crazy overvalued type highs, and Qualcomm's like dirt cheap still at the highs. So again, this is just the stuff is just moving weirdly, reacting weirdly. We haven't had any rotation to value, which I still expect is going to happen in a huge way, but we just haven't had it. So anyway, I'll kind of end the diatribe there, but I think the question was a great question, because I think inside the question on Trivago and Twitter is like, well, hey, if we start seeing good reports from the beaten up kind of value areas of tech, will they start kind of feeding on themselves? And I actually think that could. Like the more good reports we see out of the beaten up areas of tech. By the way, I would throw energy and finance in there too. It's basically the market's in the search for leadership. So we've lost the generals. The generals were FANG and cloud. We've lost those. And then in transitionary periods, markets get very confused and have a tough time going up. And so it's easier for them to go down until the next round or group of generals are found. I actually think that's the other big reason what we're going down. We lost the former generals, and we've yet to find the new generals. And so until the market and the generals don't have to be 5 specific names. A lot of times they are, but they could be groups. Like 5G could be a general. Fiber optics could be a general. Value tech could be a general. So sometimes the generals broaden out. That's exactly what happened in 2013. You went from 5, 8, 10, 15 stocks going up and producing all the return of the market to literally hundreds of stocks took over. So all the former winners started performing poorly, and hundreds of stocks went up a lot. And frankly, that could happen now. I don't know that that's going to happen. To me, that's what should happen. We're way long overdue. Anyway, I'll stop there, and you can fire away with whatever we had. But that's the one thing we have just not seen. We've had fleeting bouts of rotations to value, cheap tech, finance, but they haven't stuck. I think the longest rotation trade that stuck was in the spring and only lasted for about 6 weeks.
All right, I wanted to get your takeaways from the Texas Instrument call, TXN, and if you learned anything as far as where we are in the semi-cycle, and if it's any different than what you had expected.
Well, no, because Texas Instruments is pretty much FANG cloud contingent. It's a low growth or lower growth stock that trades like Teflon. And again, I'm not saying anything bad about Texas Instruments per se. There was a time that this was a very undervalued stock, and it was a really good buy. Probably, and at the bottom in 2016, in fact, it might have been a great buy. And I remember in 2013, by the way, Texas Instruments was undeniably great buy. But that stock has gone. I mean, it had a huge move, not just over a 1 or 2 year period of time, but more like a 3, 4, 5 year period of time. It went from being a super cheap semiconductor stock to a pretty expensive semiconductor stock, especially relative to its growth rate. I mean, honestly, I'm surprised it's only down 4%. And I think, the stocks might actually be getting in a position. I still think this is an index that could drop quite a bit, but the stocks has put in one of the largest declines. And what's interesting is it's not like Texas Instruments isn't producing really nice earnings results. I mean, it's still pretty fairly valued or modestly valued on a PE basis, but again, that's a poor way to value tech. It's pretty expensive for a semiconductor trading at 6 times sales. That's getting up there. I mean, semiconductor stocks generally trade at price to sales ratios well below that, even if they're in a fairly hot streak. So we'll just have to see. But I mean, the SOX has come down. Avago's come down a lot. What have we not really seen come down a ton is a stock like NVIDIA, which represents a big part of the SOX. One thing you always have to look at with the semiconductor index, it can be a little fooling because it's extremely market cap weighted. So there was a time when the SOX was basically Intel. Well, now the SOX is probably Intel, NVIDIA, and Avago. So the SOX isn't. It's kind of a weirdly constructed index it sort of overweights the largest names or the most recent winners much more than other indices, I think, do. I'd have to go back and look at exactly, but I'm almost positive. I think if you're looking at the stocks, you're largely looking at, Intel, Nvidia, and Avago, and maybe Texan. I'd have to go back and double check that, but it's not an index that is sort of equally weighting the top like 40 names. It's a very skewed market cap weighted index, and at this point, there's a lot of semiconductor stocks that have put in pretty good corrections. So, I think we've talked about this, and I'll just add, something like a Skyworks is becoming ever more intriguing. It's not so much that they're down huge from highs, but you could have bought Skyworks in early 2015, and we're over 3.5 years later now. That stock has gone nowhere. In the meantime, they've put in a ton of earnings and cash flow and revenues and have grown. The company's grown a lot in the last 3 or 4 years, and the stock's dead flat. In fact, if you bought it at 107 in 2015, you're down 20%. So, and there's a lot of stocks or more semiconductor stocks looking like that now. So I don't know. The one thing I don't like the look of the stocks on a chart. But then if you start looking at the individual names underneath the stocks, you either see a ton of damage or you see stocks like Skyworks, which literally hit highs years ago and have still been growing pretty good, but the stock price hasn't gone up. Look, another one would be like a Cirrus Logic, and there's some issues. Some people believe they're going to increase content in the new iPhone. Some people believe they've lost content in the new iPhones. I guess the next 2 quarters will tell. But this thing's been more than cut in half. And then I guess the last thing I would say about the stocks is it's almost like there's an Apple paradox. And what I mean by that is Apple hasn't taken a hit at all. They've been very, very Teflon in their own right. And yet it's hard to find an Apple supplier that hasn't had at least a 25% correction off of highs, if not more. A lot of them have 35 to 50% corrections off of highs. So that's the one thing that is kind of strange, is that you haven't really seen any decline or any enthusiasm lost for Apple shares, yet the suppliers, and I would argue that the current cycle that we're going into is probably going to be a better supplier cycle than the previous one. And the reason is because you have more phone models that can sell well. So, I think we talked about this. There's more models now that have 3D sensing in it. There's more phone model that's, you kind of had 2 models sell well in the last cycle. This cycle, we might have 4 models that sell well. So I think there's going to be more dispersion in the iPhone sales across the iPhone models. So I don't know. We'll have to see. But that's another one of those very odd things that you would think, given where Apple is and how the chart looks and just how much it's advanced over the last 2 years, it's hard to find an Apple supplier that even looks like Apple's chart. And usually there is a tighter correlation.
All right. As far as what we have on the horizon, as far as earnings, what are the ones that you're most excited about that you're going to get very key indications as far as your bulk of your portfolio?
Well, I think tonight's a good indicator. Tomorrow's a good indicator. Let's just talk about tonight. So again, sort of in my short camp, or things that I think are good shorts. Doesn't mean I'm short all these. It's just intellectually, I think they're good short. AMD, Citrix, F5, Microsoft. I am short Microsoft. So again, all these stocks share kind of common similarities. They've gone up a lot, pretty highly valued. Growth rates probably. Like F5 is a stock that, in fact, I've been looking at shorting that just because. Again, very modest growth rate and huge increase in price appreciation in that thing. It's not egregiously expensive though on my main metric, which is like price to sales or EV ratios, but it just looks like a chart, and it just sort of looks like a chart that feels like it could drop. I'm going to wait to see what the earnings are on it, and it has put in a drop. It's dropped 35 points off of highs. What is that, 15-17%, given its price? So not a huge percentage decline. But again, here would be my dream scenario. So what else do we have reporting? We have Visa reporting, but we have like a new company, Pluralsight. PS is the symbol. And so it would be interesting if a ServiceNow, Microsoft, F5, Citrix sort of generally report good. By the way, I do expect most of these companies will keep reporting well. But the stocks don't go up or go down. And then maybe something like a Pluralsight, which is probably taking a big beating. Let me just look. This is not a name I know. Yeah, I mean, that's down quite a bit. It had a spike high. That's basically kind of where it was at the IPO. I wouldn't be surprised if Pluralsight has better growth than all those names I just mentioned. And, you know, let's see if they have a good report and get rewarded, where maybe some of these other guys have good reports and don't get rewarded. I mean, that's at some point we just have to have different leaders, because if we're still relying on FANG and hype cloud names to lead us, I don't think we're going to go anywhere. I mean, we could have a bear market for another year or two if all the market keeps doing is trading off of FANG in cloud. And then tomorrow, you know, you have another really good, I mean, you got Shopify, highly valued name, Grubhub, highly valued name. Twitter's had a 40% decline from again, a good high. I think the 40% decline is excessive. You have Carbon Black tomorrow night. You have Amazon tomorrow night, right? So again, we have a good mix of a beaten up, high growth tech name that's going to report amid a lot of names that are Proof Point's another very highly valued name. They do have pretty good growth, but it's still a very highly valued name. So really, today and tomorrow, I think are going to be a good test. You know, do we have a bunch of good reports which result in another FANG rally? We could. If that happens, I think you probably got to sell into the rallies, at least trim into the rallies. Because if all that rallies is sort of FANG and Microsoft, you know, we probably get beaten up again in hours to days. However, if you get good reports and the FANG stocks don't really go up a whole lot, and a name like a Carbon Black or a name like Twitter, or by the way, Intel's still a very cheap name. I mean, it's not like Intel's gone up a ton. Intel's going into a pretty good cycle, or have been in a good cycle, and they've also had Intel's dropped 20%. That's definitely in the value tech camp. So that's kind of what I want to see. I want to see Carbon Black, Twitter, Intel, even a Snap. I wouldn't be surprised if Snap trades better. We could spend some time talking about Snap. I think there's an interesting setup there. But anyway, just to round up that thought, I actually think tonight and tomorrow should be a really good tell for what could happen in this market. But still, here's the thing: don't get overly. I would say don't make too much or too little out of it, because we're not past the midterms yet. So even if everything pans out exactly to my dream scenario, I'm probably not going to get that excited and might do some trimming into it, just because until we're past the interns and the midterms, I'm not sure I trust any big rally right now.
All right. Well, since you brought it up, why don't we talk about the Snapchat and potential setup that you see? Yeah.
So I mean, if there was ever a time to take a contrarian bet, and I might do it. I have today and I have tomorrow to do it. As I said, I really hate buying stuff hours or a day before they report. In Snap's case, though, I don't mind as much. One, the stock hasn't done anything, so it's just sitting here. It's up. What is it? Up 4 cents today. But I think if there was ever a time to just take a chance, and this is what I call kind of a shrewd gambler's chance at a stock that's been horrifically beaten up, and by the way, deservedly so. I mean, I've been on record and said, you know, Snap may not make it as a standalone company. I think I said that the very first time you and I ever talked about it, in fact. And probably one of my best calls in years is saying, literally the day of Snap's IPOs, is saying, hey, increase your long in Twitter and short Snap. And that pair trade was, a home run. But there's no way I'd be short Snap here. Sometimes when the facts change, I change my mind. I'm now probably have a more open mind to see, can they kind of take some lessons from the punishment that they've had and kind of try to transition the company into one that has a higher probability of surviving. I'm still not crazy about their platform, but tech companies can pivot. They can do different things. They do have a big audience. They do have big audience growth. So, I mean, and here's the best thing about Snap is actually the technical setup. I mean, there's literally no resistance until 1060. So if the thing does pop, you could have a huge high percentage move. I mean, again, it's just because the price is so cheap, right? But I mean, if they go to 1060, I don't know what's the math on that. I guess it's 4 points on a $7 stock. I mean, you're talking 50, 55, 60% move. So there's a high likelihood that I may just take a flyer in that thing. It won't be big because I never do something like that in a big way. But is there another person on the planet who thinks you should buy Snap here? I don't know. Nobody has yet introduced themselves and say, hey, I agree with you that Snap may be a buy. Most people just think it's gonna get blown away into obscurity and maybe disappear. And isn't it funny now that all the analysts that once were positive on Snap are now coming into the bearish camp now? So you know what I'm not even gonna waste my breath saying what I think about that. But yeah, I don't know. I mean, hey, now is it entirely possible that I eat 20%? Sure. But again, how I do things a lot of times has nothing to do with a prediction. It has to do with how I think the math will play out, and how I think about the math on. And I don't even know if it would go down 20%. So it's if you're basically, I'm here to be the best way to say it. If you're willing to risk a 10, 12, 15% drop in Snap, you could catch as much as 5, 6, 7 to 1 upside percentage wise. So, if you're willing to take a 10% hit, you may be able to make 50 to 70% upside. Those are pretty good. That's pretty good math. And I think that's kind of how it lays out. And so let's just say you have a roughly equal probability of losing 10 or roughly equal probability of making 50 plus. I'll take those odds any day. But that's how I see Snap. And again, I'm not going to go crazy on it. If I do go long, I'm not even 100% sure I will. But I'm definitely thinking about it and might do it.
All right. Let's see.
This would be, I guess you would call this the ultimate. I mean, that's like the contrarian of the contrarian of the contrary trades. I can't think of some. I mean, maybe Twitter at 1314 was as hated as Snap. I honestly think it was. In fact, Twitter might have been more hated because just more people hated it. I mean, Snap has created, this huge base of people that hate it. It's more of a small group of hatred on Snap. And it's more, Snap is really more people like me that didn't like the name early on, sort of saying, hey, I was right. So there's not much to say on Snap because I was right and it's still going down. Now I don't, most people would say I don't really see a reason to own it. I'm a little bit more flexible. I can hate something at one price and I can like it at another. And I don't know. I have to keep seeing. I would say over the next 2-3 quarters, I will probably be able to make a pretty firm call on the survivability of Snap. And I've seen companies get religion, so it's entirely possible that Snap could get religion and do things to make themselves much more sustainable. So we'll see what happens. I do think it's an interesting speculation. Put it that way.
All right. So let's step out of the tech sector and address a question that we got on the listener feedback asking if you have any opinion on SLCA. You've mentioned this one at least a couple of times in the past, and was just curious if you had any thoughts on SLCA. This one's really gotten
well, yeah, down. I do. I have. So this would be one. I mean, I have a small long in this. So this would be one. So there's sometimes that I can't say I don't care, because I always care about gains and losses, but I would, maybe the word "don't worry" is better. So I just don't worry. I don't worry that I got a pretty big percentage decline. I mean, the best thing I've thought about adding to this really the last 2 months, I've thought about adding to lots, and I've done a few nibbles here and there. But honestly, the best thing I've done is let the selling play out and not try to overtrade and not try to over-anticipate and not buy too many things way too high. And so, it's one thing to hold a position you already have. It's another to add to it 5, 6, 7 times before it hits a low. So the one thing I'll say about silica, and it's probably going to depend how other stuff play out, but it's very hard. It's increasingly attractive to me. I always value everything versus everything else. So I kind of have to see. I mean, there's just so many names that I like that have that I already thought were cheap that have gotten a lot cheaper. I don't know. Let's just say use MTSI. If MTSI was 23, it would be much easier for me to buy silica here. I mean, I could flat out swap some if I wanted to. I could. I mean, for every share of MTSI at 23, I could buy almost 2 shares of silica, right? Well, MTSI is not at 23; it's at 14.37, which is just a crazy price for it. So it's around the same price as silica. So it's like, well, So first of all, I'm not going to swap any of it. Secondly, if I do buy something else, and by the way, MTSI is not the only one. I got 10 names I could buy, which I think are exceedingly cheap. So the competition for my dollar is harder, but I like it. It's attractive. I like it. I think it's good price. I mean, I would almost say silica is sort of a good example. I mean, it's the energy trade is a very odd trade to me. I was looking at Apache the other day. Again, what do we have oil? You tell me. I haven't looked at the oil today. Is it $80? Is it 78?
Oil?
I'm talking
67.
Yeah, price of oil.
Around 67.
Okay, so it's still pretty close to 70. I mean, remember people when oil was 36 saying it was going to go to 26 and completely, missed the fact that it was going to double. So, I mean, the oil stocks on a relative basis, relative to the price of oil, again, it's just that, I mean, these stocks have been hammered too. So we could talk about the finance stocks. A lot of finance stocks have been hammered. But yeah, I actually think there's starting to be a lot of value in the oil group. Silica is a very interesting name. I do have a small long in it. Geez, I'm probably down 6 points or something like that, maybe five or six. So, I'm certainly not going to sell it here. I might add to it. But for me, it's competition. I mean, even something like a Micron, which I've talked about, every $1.50, this thing drops from 40. So 38.50, 36, 34.50, etc. I mean, this thing's starting to get pretty darn attractive to me. And there's just a lot of stuff that I find very, very compelling. We just need the end of this sort of this liquidity vortex. But no, I think silica. Honestly, the one thing I'll say, I know they reported the other day. I've not looked at the report. I've not listened to the conference call. My guess is it probably wasn't very good. But you know what? Just based on how stocks trade, they might have had an okay report, and the stock still might have dropped as much as it did. So I don't know. Do you know if the report was good?
I'd have to look back.
Yeah, I'd have to look. But I mean, now especially if I will eventually look at, probably this weekend, I'll look at that report. If the report was relatively good and they still did what they did to it, that makes my attractiveness even rise for it. So no, I like the name. But it's like if everything you like goes down sort of 20-25%, do you buy a different name just to have a different name, or do you increase what you already have? I tend to increase what I already have unless I feel I've got enough of something. So, because I'm not one to feel like, oh, I just need to get a different name and that'll fix what's broken, right? Or I need to get a different name and that will break me out of a slump. I don't really believe in those things. Stocks move the way they move. They move when they move. There's huge forces out there. You can do everything right and have a bunch of your stocks go down. And that doesn't mean you need to sell them. It doesn't mean you need to go 100% to cash and redo everything. Sometimes you just have to wait. And so that's kind of, another name that I'm going to throw out. Now, I would say, well, this would be adding a new name, but it wouldn't, because I've owned this before and I did exceedingly well in this. But something like Nutanix. I mean, this thing's dropped. Has it dropped 30 points now? I think, well, almost. I mean, you start putting in 30-point declines. I think that thing's dropped 28 points from highs. That thing lines up really good on a valuation basis. So because they even at highs, they were not nearly as overvalued as like Adobe's and Intuit's and on a relative basis, Microsoft and loads of names like that. So something like that, even again, kind of tough for me to keep firing at Silica. When I can, Nutanix is actually starting to get pretty well below, what my price target is on the name. So it's, there's some pretty interesting stuff out there. I had no interest in Nutanix at 55 to 65-ish because it was pretty close to sort of my price target. I've actually increased my price target, and so now, I don't know. Again, that name's really interesting. So we'll see what happens, but like I say, if everything drops 20-25%, I don't necessarily think I gotta go do new names. I just think, okay, so do I concentrate more on the ones I have, or do I just hunker in and just wait for this thing to play out, right? And then sort of attack things on the early turn on the way back up, which is my preferred methodology. The one thing I'll close on Silica, just let it trade. I mean, give it 3, 4, 5 days, let it trade. I mean, could you miss a nice short-term spike? You could, but I mean, until you see this thing, I used to preach. I think I joined briefing during kind of a rough period in the market, if I remember right. And back then, I was like, look, just wait for a lot of these things to retake 5 EMAs. Just let them retake 5 EMAs at the very earliest. Let them retake 3 EMAs. That's a EMA of 3, so it's only a 3-day or 3-hour. On a 2-hour chart, it would be a 6-hour time frame. But let these things sell off. Give them some room. Let them basically go back up and at least start trading at or above a 5 EMA. And you know what? You're still going to get really, really good prices, because when a stock first reclaims a 5 EMA after a huge percentage drop, you're still buying the stock probably in the bottom 20th percentile or maybe even the bottom 10th percentile of where it's traded for the last year. So that's kind of what I'm doing too on a lot of other things. It's like, look, I want to see stocks at least show the ability to kind of get back and trade at or above and hold 5 EMAs. And that's a good rule. I mean, that's not, I don't say I've invented that rule. I probably learned that rule listening, reading tons of other people. But I think that's one I've kind of adopted to myself. And I'll break it. I don't. It's not like a hard, fast thing I have to live by. But yeah, I mean, let the thing trade, let it age, give it some time, and let's see how it interacts with the short-term EMA. Because sometimes you think the selling's done, a stock will go up to a 5 or a 10 EMA, and then what do? They just pound it right back down, and then they do that 2 or 3 or 4 times. And I've seen stock where sometimes their stocks literally have to trade above the 10 EMA 4, 5, 6 times before it finally breaks through. And that can take a while. That can take a number of weeks sometimes. So as much as I might like something, sometimes if something's in a real steep decline, I just let the 5 EMA catch up with it and then address it then.
All right. Well, look at that. It seems like we can burn through an hour in no time, right? We get off on a roll, and we talk about how many stocks? At least 15 or so. And here we are.
But I would say this is pretty productive. We're going to probably wind off pretty soon. The one thing I like to say, we could be getting pretty close. Pretty close to what I mean by, some kind of tradable low, some kind of a durable low. We put in a classic, what I call my sentiment retest, where stock prices retested, but sentiment did not. Again, most of the time that's good enough. Most of the time, though, we don't have a midterm election. So whatever you want to add, and any other questions you have, but I just want to make sure I get that in if somebody didn't hear me say that at the beginning of the call.
No, I think that covers pretty much everything, and we kind of end up right where we started, and that being the initial question of where we are in that cycle. And I think it's a good takeaway to just leave it at, hey, this could be a potential for a tradable low, at least in the NASDAQ. So we shall see. I'll tell you what, let's end it there, and we can pick things up after a few more days of earnings. So either Friday or early next week, and we'll see how things are played out after that.
Yeah, I mean, and I think the best thing about between now, tomorrow, even Friday morning, there's a report or two, and then we have a ton of reports next Monday, Tuesday, Wednesday. So put it this way, at least the next 3 to 5 days, we're going to have enough new earnings reports to chew on that maybe it's possible maybe earnings start becoming more of the conversation again. Mm-hmm. You know, I don't know, have you ever noticed this, that when stocks themselves and earnings are not really part of the conversation of the price action, generally stocks are selling off.
Yeah.
You know what I mean? When the stock results start coming back into the conversation, I don't know, it just seems to me a lot of times that's usually when buying interest comes back. I don't know, not always. I mean, that wasn't the case during crashes and corrections. Oh, by the way, I did think of one other thing. Do we have time for one other comment?
Sure.
Okay. So this is something, I think I forgot to mention this, but this is something I innately know and sort of live and breathe. Okay, so I think everybody wants to think of corrections in a linear manner, meaning that all corrections are sort of the same, the math is the same. But just think about this. So let's say we're going into a period, or we're in a period where revenue and earnings are declining. And so let's say revenues and earnings are roughly declining. You know, again, we have a bad period or recession or something. Revenues and earnings are declining 10%. Okay, let's say we have a 20% correction. On a relative basis, stocks only got 10% cheaper because the underlying value of companies should be going down because their earnings and or revenues and or cash flow are being reduced, right? So there's actually a big difference for a correction that occurs during a declining period or a recessionary period, and one where, hey, you could argue that maybe there's some ingredients, growth is slowing, maybe there's some people start worried about, peak earnings. I mean, hey, I've been talking about peak earnings in FANG and cloud for a while, but there's a huge difference on a relative basis. Let's say if we have a 20% decline in the market, let's use 15, because 15 is more akin to what's going on now. But yet, let's say earnings and revenue growth are still rising by roughly 15%. Well, on a relative basis, stocks are now 30% cheaper. So that's why I think some people are maybe a little better at timing some of this stuff, because I think they look at stuff on a relative basis. If you kind of view that, hey, all corrections are just the math and what's the percent of the correction, well, you don't have a basis. And if you're just thinking, and I think that's why a lot of people get in trouble. They want to buy corrections during bear markets or recessions way too early, because by the time results start declining, stocks really aren't that much cheaper on a relative basis. So again, if you have something really ugly and earnings are decelerating by 20%, you need stocks to drop 40% to make them 20% cheaper on a relative basis. Whereas, hey, if earnings and revenues are still growing 20%. It takes a very small decline. In fact, if stocks just go sideways for a year, on a relative basis, they're 20% cheaper. I think so. I think that's maybe why this kind of feels pretty ugly, because you still have earnings growth, you still have revenue growth, and you have stocks getting a fair bit cheaper. So on a relative basis, this correction is probably pretty steep now. Anyway, I just want to put that out there, because if you never think about it that way, you're actually missing a pretty important pretty important piece of market math.
All right. Well, we'll leave it off on that pro tip right there. Well, as always, you've given us a lot of information. I'm pretty sure we're good to go as far as recording. I had that all set up, and that's what took us a little bit, so I apologize for the little bit of delay to the listeners as far as getting things rolling. I think we were off by like 5 minutes or so, but hopefully everyone got some good information out of this. And as always, Sean, thanks a lot for joining us, and good luck on all the earnings that are coming out.
Hey, thanks. And like I say, maybe we should just talk after the midterms.
Well, we would have people. No, they'd be outside protesting, getting you on. So I'm not even gonna do that. I mean,
That's funny.
but yeah, we'll definitely build up to the to the midterms. How's that?
No, that's fine. Like I said, don't mean to make light of it, but I don't know. I mean, the thing that people aren't thinking about. What if that's the most important factor? What if there's just uncertainty and never so that it's shoot first, ask questions later, and once I don't believe it's that simple either, but I don't know. It could be. Meaning after the midterms, assuming this, all things being equal, assuming earnings are good. I don't know. What if we have a rip roaring move?
We very well might. It wouldn't be all that surprising because then we'll have the seasonal holiday period and Santa Claus rally and all that goes with that. So it very well could be. Maybe it's setting up for that.
Yeah, we'll know. Well, we'll know later, man.
Well, the good thing is that we'll be here to talk about it, so we'll definitely be at least being able to have some hypotheses out there as to what's moving us one way or the other. So, as always, Sean, good stuff. Thanks for joining us today. All right.